Hey everybody, Andrew Maniaci here, financial advisor with TBA Investment Services available through QSO Financial Services. And today we're going to talk about the differences between traditional and Roth IRAs. Tax season is upon us, and it's this time of year that we get the most questions about the different IRA options that you have. So while I'm not a licensed tax professional, I can certainly help answer questions on the differences between the IRAs available to you. Any more specific tax questions, you certainly want to talk to your tax person. With that being said, we'll jump right into the presentation. And on the screen here, you'll see my information. If you need to contact me after viewing the presentation with specific questions on your IRA needs, you've got my phone number, my email there. I am located at both the Front Street branch and the South Airport branch of TBA Credit Union. So please reach out anytime you have any questions. Otherwise, we'll get rolling into the presentation. So what we really want to focus on here with the traditional versus the Roth is, well, when do I get my tax savings? That's the whole point of doing it. I mean, certainly we are opening a traditional IRA and investing to save for retirement and to have more money to spend when we're not working. But really, we're doing it for a tax savings where we're trying to choose the best IRA for our personal situations. So they're each going to give us a different kind of tax break. With the traditional IRA, you're getting that tax break today. So with the traditional IRA, when you put money in, assuming you qualify, and again, this is a situation where you want to make sure you qualify for the tax break, talk to your tax person, or frankly, if you're going through TurboTax or some kind of tax software, they will tell you if you qualify for traditional IRA deductions. But if you do qualify, you put that money in a traditional IRA and you get a tax break today. So it is deducted from your taxable income today, and it grows, as we can see on the screen here, it grows tax deferred until at some point down the road, you take money out of the traditional IRA. And when you take money out of the traditional IRA, that is when you will pay taxes on the money that's in the account. So with the traditional IRA, you're avoiding taxes today, and you're deferring taxes until down the road when you're retired and you're hoping you're in a lower tax bracket so you can take advantage of that situation. But we just don't know what tax brackets are going to be. But with traditional IRAs, we are deferring taxes for down the road. We're getting a tax break today and helping us on today's taxes. With a Roth, the only thing that changed on this screen is that tax-free accumulation. So with the Roth IRA, remember with the traditional, when you put money in that traditional IRA, you get a tax break today, but you pay taxes when you take it out. The Roth IRA is the exact opposite. You get no tax break today for putting money into a Roth IRA. You might qualify for some tax credits, but you'll get no tax break today for the most part. The tax break with a Roth IRA comes down the road. So down the road with a Roth IRA, as long as that Roth IRA has been open for at least 5 years, and as long as you're over 59 and a half or have another qualifying life event, that distribution from a Roth will be completely tax-free. So as we can see on the top of the screen here, Roth IRA distributions are tax-free as long as they are qualified distributions. So with the Roth, we get the tax break tomorrow. With the traditional, we get that tax break today. If we dig a little deeper into the differences between the two, we'll go line by line here. So there's no age limit with a traditional or Roth. So there's no age limits, but we do have to qualify in other ways. For example, if you want to make a contribution to either one, you have to have taxable income. So you have to have some kind of taxable working income to be able to make a contribution. Or if you're married and you file jointly, your spouse has to have working income. So for eligibility requirements, you definitely want to talk to a tax person, make sure you even qualify to make a contribution to a traditional or a Roth IRA. The contribution limits are the same, that second line item. In 2021, you can put $6,000 into a traditional or a Roth, not both. it's $6,000 total into your IRAs. Or if you're over 50 years old, you can put up to $7,000 in traditional or Roth, or the combination of the two cannot exceed $7,000 per person. For rollovers, we have the ability with both traditional and Roth IRAs to roll over 401ks, 403bs, 457s. We just want to make sure that we're rolling it over properly. For example, if you're rolling over a traditional 401k into a Roth IRA, there's going to be some tax consequences there. So if you have any questions about rollovers, please let me know. I'd be happy to assist, and certainly talk to a tax person to make sure it's not going to screw up your taxes. But give me a call and we can talk about the different rollover options you have and make sure that you're doing the right thing and make sure it makes sense for your situation. If we continue with the traditional versus the Roth, the deductible contributions like I talked about earlier. With the traditional IRA, when you make contributions to that traditional IRA, those contributions are deducted from your taxable income. But it does depend on certain factors. You know, if you're covered, for example, by an employer retirement plan like a 401k, if you're covered by a 401k, you might not be able to make a deductible traditional IRA contribution. Also, if you have your adjusted gross income is too high, you might not maybe be able to make a deductible traditional IRA contribution. So this is situations where you, again, want to talk to a tax person, make sure you qualify. With the Roth IRA, your contributions are not deductible. So with the Roth IRA, when you put money in, you cannot deduct those contributions. You get no tax break today, like we talked about earlier, but the tax break comes down the road with that Roth IRA, and the distributions are tax-free. Required minimum distributions with a traditional IRA, again, you get that tax break today with that traditional IRA, but at some point you have to pay taxes when you take money out. And there's something called a required minimum distribution. So think about that traditional IRA. You're putting money into that traditional and you're not paying taxes on it. And it grows tax deferred over years, sometimes decades or multiple decades. And you have not paid a single penny in tax. Well, at some point, the IRS wants their tax money. And for most people at this point, because of a recent law change, that age is 72. Once you turn 72 years old, you have to begin taking distributions from your traditional IRA account so that Uncle Sam can collect his taxes. So if you have any questions about traditional IRAs and required minimum distributions, let me know. There are no required minimum distributions on Roth IRAs because the Roth IRA grows tax-free. Uncle Sam doesn't care when you take money out because it's tax-free anyway. The one exception there, if you can see under the Roth where it says beneficiaries are subject to RMDs. So if you are inheriting or you have inherited a Roth IRA, then you may have to take required minimum distributions from that Roth IRA, even though it's tax-free. If it's inherited, you may have to take distributions. Give me a call, we can talk about that further. And finally, federal taxation on distributions. When you take money out of a traditional IRA, it is taxed as ordinary income when distributed. So every penny you take out of a traditional IRA is going to be added to your taxable income. So when you're ready to take money out of a traditional IRA, you just want to make sure you're not taking out too much too quickly. Obviously, because number one, you don't want to spend all your retirement money and run out of money. You want to be able to pay for your retirement. But the other part is you might push yourself into a higher tax bracket if you take too much. So just keep an eye on how much you're taking out of that traditional IRA. Talk to your tax person, make sure it makes sense, and certainly talk to a financial advisor like myself and make sure that you're not going to liquidate your entire retirement savings early. We don't want that. With the Roth IRA, distributions of contributions are not subject to federal income tax, and they are completely tax-free if the Roth IRA, and this is the key, has been held for 5 years. So I have a lot of people that come in that open an IRA at age 58 and they get to 59 and a half years old here. And most people know that at age 59 and a half, that Roth IRA should be tax-free because I'm 59 and a half. There's no more taxes or penalties. Well, if you only opened your Roth when you're 58 years old, it's only been open for a year and a half. It has not been open for 5 years. It needs to be open for 5 years. And you need to be over 59 and a half for those distributions to be tax-free. So if you're 58 and you open up a Roth IRA, you actually have to be 63 years old for it to be completely tax-free. So we just want to watch that 5-year rule, and you want to make sure that you're taking a qualified distribution from your Roth IRA. If you do have a Roth IRA or a traditional IRA and you have questions about distributions and the taxability, again, I'm here to help. I'm happy to help. Give me a call or send me an email or talk to your tax person, certainly, and make sure that any distributions you take from any of your retirement accounts will not damage your tax situation. So that's all I've got for today. Thank you for joining. Again, my name was Andrew Maniaci, TBA Investment Services, available through QSO Financial Services here at TBA Credit Union. Thank you very much and have a great day.